Good evening, everybody, and thank you for the opportunity you've given us this evening to present to you. We're going to present our half-year results, but we're going to give you a bit of background about the business as well. But before I do that, I'd like to introduce you to my colleagues.
Phil Byrom, Group CFO with Watkin Jones, joined the group in 2002, originally qualified with Pricewaterhouse.
Alex Pease, Group Investment Director, joined Watkin Jones in 2010, having previously been with Savills investment management team for 6 years.
Just give you a bit of background of the business and how we've ended up as a company on AIM. The business was established in 1791 in Bangor in North Wales as a joinery manufacturer and undertaker. I've worked through all parts of the business, from labouring, setting out engineering and everything. So I've really grown up with the business for the whole of my life. And I realised at 18, coming out of school, that it was going to be hard work. So I managed to get an offer to go to Portsmouth and do a degree in construction management there for 3 years. And when I came back in 1990, I found what was probably a sleepy North Wales building contractor, sort of northwest Wales, revenue about £4 million, £4 to £5 million. And we were still an undertaker at that time, which was the first part of the business that I said, well, we're not getting involved with that because measuring dead bodies was not for me. I can assure you that. So I managed to close that bit down, but it still wasn't enough. And at the time, I managed to persuade my father, who was the then managing director, to let me open an office in Chester. And that was really the catalyst for the business in how we've got to where we are today. Whitbread was my first big break, where we managed to persuade them to let us build a travel inn, which we now know as Premier Inn. And we built probably about 30 of the first 100 travel inns that were put around the UK. And that's what really gave us that opportunity to work nationwide and believe in the product that we built. Following that, we were able to get our first contract with Tesco, and then, of course, once you've done the first one, the other supermarkets will join. So we were very much at that time a general contractor. And in 1999, we did our first student accommodation project as a general contractor, but with a twist in that we effectively put our working capital into the development for a fee of, at that time, which I thought was a fortune, of about 250,000. We rolled that on. The client we were working for brought us the land opportunities. We built it. He paid us at the end. But after doing that for about 2 or 3 years, I realised what he was doing was he was getting his funding for when we got to PC. And as I say, I couldn't work out why his cars were getting bigger, his suits were getting sharper, and we had no money in the bank until we finished the job. So we managed to then turn that on its head and go, well, why don't we do what he's doing? And that's when we developed the turnkey part of the development, which was great until we got to 2008. Everybody had thrown a huge amount of money at us, and we had debt on the balance sheet at that time, about £160 million. Again, we were forward committed on a turnkey basis for projects up to about 2010. So everything was fine. You know, what was anybody going to do? We owed the banks a huge amount of money. So, you know, I felt pretty secure in position. But then we were banking with HBOS. Lloyds banking group took them over and said, we'd like our money back, please. And it was at that time, being the 9th generation of the family, that I thought, oh God, I've got to do something about this. Nothing can happen on my watch. And that's where we developed the forward sale model, where we would identify the site, but not actually acquire the site. At the same time, there was a lot of institutional investment, particularly private equity interest, and they were willing to come in and effectively fund the whole process. And then what we actually did then is we generated and repaid Lloyds RBS in a 2-year period that £160 million. And suddenly we realised, well, why do we want to go back to anything else? We're free of all debt. We'll just continue the model that we've developed with these institutions, with more institutions coming in. and that's what we've continued to do. At the same time, we've sort of exited general contracting market, and we now have a business that is predominantly focused on student accommodation. And I'll talk you through the model shortly. But what we've also seen is great opportunity in the private rented sector, where our existing clients are the ones that are driving us to market. And we're not being very aggressive in what we do, in what our projections are in the future, but Alex is going to talk to you a bit shortly about how we take that forward into the next part of our business growth. So I think for those of you who are not familiar with the business and the model and the market we operate in, I think before we talk about numbers and our sort of investment highlights, it would be worth us, if I could ask you to turn to page 12, I can just talk you through the model as we go forward. Page 12 just shows a development we completed in Sheffield 12 months ago, 2 years ago now, believe it or not, yeah. And turning over is a development we completed in Birmingham last summer. But the slide 14 really shows the model. And what we do is we provide an end-to-end solution to institutional investors that want access to the asset class but don't want to go out and buy an existing portfolio because the competitive tension in that particular area is huge. So how does our model work? Well, it gives us great visibility on what we do, and it's very low risk. The demand on our working capital is extremely low. And there's a number of competitive advantages we've got as we go through the cycle in those four specific stages that I've set out there. But really, to make it sort of come to life, it's probably best if we can, at the bottom of that page, I put together what a theoretical example on a typical 500-bed scheme. When we appraise a particular site, when we're looking to acquire a site, we very much do a top-down appraisal. So to establish what the gross development value of a particular site is likely to be, we've got visibility on rents, we've got visibility on term times, and we've got visibility on yield. We can talk a bit where yields have gone around Brexit as we go through the presentation. From that, then, we work on a typical 20% return. So we take that off. We do our own construction work. So we've got a good handle on what that construction cost will be for a particular project. So we can take that off. We can then apply the funding costs that our particular fund would look to run through the project, and it's typically the running yield of what they want to achieve post-completion. And that will leave us with a residual land cost. And it's Alex and his team, their responsibility to acquire that site for as little as possible up to that ceiling. And when we acquire a site, we look to, on the typical model, acquire it on a subject to satisfactory planning basis. Now, the word satisfactory is the most important bit that goes into that contract, in that we're not actually acquiring the site until we get planning that works, that's viable for us. We've also got the opportunity to revisit that if there is a significant yield shift and it's no longer viable, we could revisit that and exit from that contract. Why does a vendor want to work with us to sell her site on that basis? Well, there's undoubtedly some uplift to them if it's got a planning consent, or we've done the work, or than if we were going to buy a site unconditionally. We may occasionally buy a site unconditionally, but that's really when we've got great visibility on the planning process on that. But we're talking much smaller lot numbers where we would take that and we would want a significant increase on the return of our 20%. So how does it work? Typical contract, we would exchange contracts with a 5 to 10% refundable deposit. That's our real sort of investment into the project. That sits in an escrow account. Occasionally we might put 50,000, 100,000 down to the vendor to sort of work with us, but you're talking 5 to 10% of a site acquisition cost. So in this particular case, where we've got a £5 million land acquisition cost, it's between £250,000 and £500,000. Then our real risk money is around the third-party planning costs. In-house, we carry a team of our own planning consultants, our own technical guys, our own cost consultants, our own estimators. So, that's part of our day-to-day overhead, which is budgeted for. Third-party planning cost would be typically consultants that we use sporadically for a particular planning application, sort of ecology-type consultants where there's no requirement to have them in our in-house at full time. So for a typical scheme of this size, third-party planning costs of around about 300,000. So we've immediately got a competitive advantage against other developers at this stage, because I estimate that other developers don't have the internal expertise or internal resource to be able to fund the planning or keep the cost as low as possible through the planning process. So we submit the planning application, we get traction. We've got a fantastic track record with planning in that in all the sites that we have acquired on this basis, we've never failed to get planning consent, and we've never not completed from a viability point of view on one of these schemes on this basis. As we get traction on the planning consent, and planning consent is a difficult process, but if you understand the process and work with the planners and do a lot of upfront work, you tend to find that planning authorities and councils have actually realised that purpose-built student accommodation is a solution to their housing problems, not a hindrance, because they can see that actually there is this flight from what we know as houses of multiple occupation, the old young one type house that we all refer to, into purpose-built. And we're also seeing as well that that it's the students themselves that are paying more for their tuition are looking for this quality, and Alex will talk to you about the market and the type of product we produce. So as we're going through the planning process, there's about 40 institutions on our sort of radar that we regularly talk to about selling a particular asset to those. And we tend to sort of try and put the sort of deals we're bringing together into sort of £100 million minimum portfolio. So 3 to 4 schemes, which really gets them, gets the pencils a bit sharper and gets them more interested in what we're trying to deliver.
It's probably just worth saying, when we go out to market, we are quite strategic in our approach. It's rare that we look to place it with an agent. We do like to work with repeat clients. I think Mark's alluded to a lot of the institutions we work for, and if you actually look at the quantum of deals we've done with them, I think we've just done probably our 12th with CBRE Global. We've done 3 with AIG, we've done 2 with M&G, 3 with L&G. We really like to strategically approach them. We know we're talking to them day in, day out. We know what sort of product they want, and we do try and sort of target particular investors for particular assets. Every now and then we will go out to the wider market to make sure we're not missing a trick, make sure that we're trying to capture, the best possible value. And, as Mark said, there's easily 40 sort of investors that we could sort of reel off who are interested in the stock at this stage. So I think what we're finding in the market at the moment is a real liquidity and a real depth of market, which has sort of really never been there before.
So as we get the traction on the plan, we look to engage. So if we would then agree heads of terms with a particular institution, that institution would effectively then step into our purchase contract. So we never actually acquire the site. So we never have to put any more money in. As the planning consent is issued, we go through judicial review period, complete the contract. The institution now owns the site, pays for the original vendor for the site, will pay us an uplift on that site. Quite happy to do that because it's all coming down from the top-down appraisal. So it's all cash flowed through. So it's a funding cost to them. They're committed in this particular project to 35 million. So how we draw down the cash is really built into the funding cost. We don't want to draw down too much because to sit in our current account, because that earns us nothing. So it's just getting that balance right about how we do it. They're also quite happy to pay us a planning gain payment on that. So in this particular example, The fund have paid us £6 million for the site. We've paid £5 million over to the vendor. The fund have also paid us a planning gain payment of £1 million. So we're cash flow up on that of about £2.5 million because of the 800 we spent previously. At the same time, we enter into a development agreement, so simultaneously enter into development agreement to then build out that asset for that particular institution on a fixed price for a particular delivery period. Now, we always look to start projects early to finish early, and in the 28,000 beds we delivered over the last 15 years, I'm pleased to say we've never failed to complete one of those schemes ahead of the academic year. So we've never had to get into the place of putting students in hotels. And the 3,500 beds that we've got due to complete this year, they're all on track to complete by the end of August at the latest.
Can I ask a question? So I can check my understanding. Is this similar to, for instance, me buying a block of flats off plan, but paying in stages rather than writing it up?
Pretty much, yes.
Okay,
yes.
right.
Yeah. They're buying the whole block, they're paying for the land, then they effectively pay us through the build process on a monthly valuation. So we put a valuation on the 16th of the month, they pay us by the 30th, so we're on 14 days there. Our supply chain are probably are on 42 days. So we actually build another month's additional cash flow into our model at that stage as well. So that's why our demand on our working capital is so light, and the extra cash that we generate is actually what's funding the third-party planning costs on the other schemes, etc. as we go forward. So just to talk a bit around construction and construction costs and how do we manage that. The student accommodation is very much a repeat product internally. So if you imagine the footprint inside, every bedroom is pretty much, and we try to work it as close to a pattern book as we can. So from a house building, if you use the house builders, everything's cut to size and it arrives and it just slots into place. Externally, the fabric will change. So we're always trying to keep everything as economic as possible. And what we've done on that is so all our sort of design teams work to this pattern book. So in theory, the skirtings and everything come cut to size. So by doing that and knowing how we do it, we can drive cost out of the supply chain. On a particular student accommodation project, there's about 60 subcontract trades. So from, if you take the security and the hoarding guys at day one to the cleaner leaving on the last day, there's about 60 trades that go through the whole process that do. Majority of that is subcontracted. Well, in fact, it's all subcontracted with the exception of management, project management, and the construction management services. They're all employed directly by the business. So we've got long-standing people that work for us. We develop that through that supply chain. We share the visibility on our pipeline. So what we realised was historically if we were doing 4,000 beds per annum, we were going out to tender on 10 schemes per annum, 10 times 400 beds, and picking 10 different subcontractors. What we've done now is we've pooled sort of a core of 6 subcontractors per trade, so 360 subcontractors in our supply chain, and we negotiate those rates with them so that everybody's aligned on the same rates. There are some variances for different regions, so if we're up in Aberdeen or down in Plymouth or obviously London as well, there'll be some small variances, but they're very much around the base cost of the particular product. So we're able to control costs particularly well. And that, again, is a competitive advantage over third-party developers that are going out to tender on an individual basis.
Who do you see as your competitors? I mean, surely you're not the only ones doing this particular way of running a scheme from start to finish. I mean, would it be local people who quite often spot the opportunity, see a site close to a university and think, let's do that? Or is there any other national sort of network of companies doing it?
I think there's a lot of people trying to do it, and obviously this process really shows us out there. But I think why are we so successful at it is because we specialise in it. If you try and compare it to something, I think it's similar to the McCarthy and Stone model where everybody's tried to do a bit of retirement housing but haven't quite matched how they do it. And I think we're in that sort of place as well. Yes, you can do it. We're concentrating. We're turning over £250 million doing this by concentrating and specialising in something. And I think the specialism brings opportunity because vendors can see, well, yes, these guys are likely to deliver. Yes, there'll be individual local developers who think, well, we can have a go at this. But have they got access into the institutions? Probably not. Institutions are quite selective in who they work for. You have to tick their, as they call them, tier 1 developer contractor status, which we're able to tick those 2 boxes. So your access to the end purchaser is a lot more restricted. And it's like anything, it goes back to the sort of what I said earlier with the Premier Inn, Travel Inn. Until you've done one, it's difficult to get onto the ladder. And then once you're on, you can get it to snowball.
So the reverse of that is somebody's got a lovely plot of land near to a university. They automatically think, that'll be Watkin Jones.
Yeah.
That's
how it works.
And how would they find that out? Is it a local agent will say you need Watkin Jones?
I think we've got a number of benefits. One, we've got a huge heritage behind us. We've been in this market since its inception, really, in terms of really purpose-built stock. So a lot of people know us just through that. We've got a big supply chain of architects, engineers. They're dotted around all around the country. They feed in a huge amount of sites. We've got relative agency experience, from myself and my team, so you feed in. So we've got all these different conduits of sort of opportunities sort of feeding into us. I think one of the best things for our business at the moment really is the institutions themselves. What we're finding is they bring us opportunities and say, we really like this site, we really like this opportunity, but we don't believe the developer's got the wherewithal to do it. Can you do a deal with him? And you parachute yourselves in. That's probably happened 3 or 4 times in the last 12 months, and it's increasingly happening on the PRS side. So I think they're becoming a great source of opportunity for us by actually saying, we want you to package this and deliver it for us.
What we found was 2010-11, we got these big institutions coming in and they're saying to me, this is all great, we're getting access to the asset class, but the last thing we want to do is manage student accommodation on a day-to-day basis, manage students. So what's the solution to that? And there was a couple of third-party management businesses out there, but from my own experience, they weren't delivering and being proactive in delivering for our clients. So we'd worked very successfully with the IQ Student Fund, which is part of the Wellcome Trust and Quintain Estates. We'd worked with them for about 4 or 5 years, and I managed to persuade who was the fund manager at the time, a lady called Rebecca Hopewell, to leave her well-paid central London job and join a North Wales business and set up this new co. But I never got her to move up to North Wales, but she set up the new business, and that's been very successful in completing the end-to-end solution for our clients. That business, effectively, the landlord takes all the risk on the income and the expenditure. We manage the whole process for that landlord in exchange for a flat fee per bed for delivering that service for them. And that is effectively annuity type income. Those contracts are typically on 3 to 7 years, but our view is we should be managing that development for that particular institution or any institution that subsequently acquires that site for in perpetuity for the length of time that operation stays as a student accommodation. And what you find is that's very much a scale business. We needed about 5,000 beds to break even on that, so that's your competitive advantage on that. From this September, we're managing over 12,000 beds, and your drop rate on that is about 65 pence now. So it's all gross margin, and we're really seeing some growth out on that with some great visibility, which I'll just talk you through when we get to the investment highlights. So that really is how the model works. We get paid all the way through, apart from that initial seed money, and it's very successful, great visibility, low risk. I think also, the institutions are locking themselves in to what they pay us. So everybody that's locked in for the 2016 deliveries, the values out to 2017, we're already locked in. So any particular movement around Brexit now, it's locked in. Where we've got to make sure is for 2018 onwards that we're pushing any change in yield through into what we pay for the sites. So about the market.
Okay. If we just turn to page 16, just really want a sort of brief overview of the market, and I'm going to look at it really some 3 different sort of parts: the investment market as a whole, and then really what underpins that, which is the supply side and the demand side in the market. I think, sort of as was alluded to, the student accommodation market, it's been around for a while now, and it really has sort of come into favour, and it's been in a lot of sort of the news. It's still classed as an alternative asset class, but it really is a maturing sector, and it's now become very much a core allocation to the vast majority of institutional funds, international funds, a very diverse sort of dynamic of investor. I think what that's given us as a sector is a much deeper market, and there's much more liquidity in the market. And if you look at sort of how the market has changed since probably the last downturn, it's a real sort of step change in who's investing in this space. I mean, if you went back to 2007, transaction levels were probably about 500 million, and this is when our market sort of was at its peak, obviously before the crash. The vast majority of players in that market were owner-operators. It was the likes of Unite, it was the likes of Opal, it was the likes of Victoria Hall. Most of them were very highly leveraged, and they were seeking their own sites, developing them out and operating them themselves. Obviously, 2008 happened, and it put a lot of pressure on some of the businesses. Opal will be the one that everyone's familiar with, who's put under most stress. But what 2008 and the downturn did was it actually made everyone sit up and look at sort of the occupational demand for our sector and how well the sector performed in a downturn. I think that was one of the most important sort of drivers for the institutional market. They'd always wanted to invest in residential in a large scale, and student accommodation seemed like the most logical way in for them because they could understand it. There was a clear income stream. They capitalised it on a yield. It gave a value. But until they really saw the performance in the downturn, they'd sort of kick the tires and sort of walk around the edge of it, but never sort of really come in. So in 2008 through to 2012, what we saw is the market performed incredibly well. Those student numbers grew, 2008, 2009, 2010, 2011. There was sort of effectively an inverse relationship between GDP dropping and student numbers growing, because everyone had always wondered, in a downturn, people go back and study, people go back to university and retrain, and really that was borne out. Obviously, as student numbers were growing, that meant occupational levels were very high. There wasn't enough product in the market, therefore rental growth was being sustained. So actually, from an occupational operational point of view, the market was very, very successful. And the private equity sector, unsurprisingly, spotted this sort of very early on, and they really put their money where their mouth was and put their equity into the game early. So the likes of Knightsbridge were backed by Oaktree. They were one of our biggest clients at the time. I think we did 10 deals with them over the period of sort of 2-3 years. That they put their money to work and sort of capitalised on that market. If you now look where the market is now, 2015 transaction levels sat at probably about 5.5 billion, something like that. So it was an exceptional year of sort of transactional levels. If you actually look at the makeup of where that money was coming, some of the early private equity money took their exit. So Oaktree sold their first portfolio, Blackstone sort of traded out one of their portfolios. And what replaced it was, people like the Canadian pension fund came in with a circa 1.1 billion acquisition of Liberty. We had Greystar coming in from the States. We had a huge number of international purchasers looking to put their money into this sector. And they're not at all nearly as leveraged as historically. So in terms of our sort of client mix in the sector now, much more diverse, much less leveraged, and sort of much more sort of stable. I think clearly everyone's sort of looking at what Brexit means for the investment market, and ultimately we're sat here and we've got a number of deals in train, and every single one of our deals is still in train, and everyone is effectively saying, thank God you're in student accommodation, because we really believe that this sector is the sector to be in, particularly in uncertain times, particularly, I wouldn't say we're in a downturn necessarily, or economic downturn, obviously huge uncertainty, but all the institutions are still liking the occupational, operational sort of model that student accommodation offers, and yeah, we are sort of very positive on it. I think, has there been a yield shift? There's no evidence either way at the moment in terms of sort of transactional levels, but again, the vast majority of sort of equity in this space is longer term, and as long as they're sort of actually getting the stock fully let and they're getting their sort of income returns, they expect that there will be yields sort of peaks and troughs.
But surely one of the things as well is that, if a 10-year government bond is all of a sudden changing hands at 0.8%, maybe 1.1, then that's actually attractive for yourselves.
Absolutely, the people still want yield effectively, and student accommodation does very much give that.
And are you only dealing with first year students?
No, not at all.
So they could stay for all 3 years?
Yeah. I think in student accommodation, rebookers is one of the key words, and if you can get your rebooker rate as high as possible, it saves on marketing, it saves on headaches. You want to get as many people rebooking your scheme as possible in any one year. And
so in a sense, you're not necessarily that dependent on new students coming in. You can cope with the existing ones staying.
Plus, I think the new supply to the market is less than what the number of new students joining the universities. So we're not keeping up with the demand. The new supply is not keeping up with the demand. So there's still this headroom of where we're at. So.
Have your rates been going up every year?
What are your rebooking rates?
I think our rebook rate's about circa 40%.
Is that changing at all?
It fluctuates in any one year, because obviously if you happen to have a year where you've got a lot of third-year students who are leaving the university, so you have to look at it as a general trend. But yeah, no, I mean, that's one of the sort of KPIs for Fresh, is to increase that rebook rate every single year, and it has been increasing. So we haven't seen a drop-off in that rebook rate.
I think what we're seeing is that the new generation coming through are very different to probably the majority of us in this room would consider. They're very much looking for brand and quality, and the house of multiple occupation is no longer attractive to the new generation coming through. The thought, I've got a 16-year-old daughter, and I said to her, you can go off and share a bathroom. That can't happen, can it? It does happen in the real world, and I think they've very much changed that, and that's what's driving it. I think also parents like the fact that it's well managed, it's secure, it's warm. You've got full-time security there. You've got the fast Wi-Fi, the whole environment. And they're also paying a lot of money for their education as well. So they're paying the £9,000 per annum fees. They're paying, from 140 to up to £300 a week for their accommodation. That sort of, whether you can get your basic rent in a house of multiple occupation at £80, plus your bills, plus your Wi-Fi, plus the absent landlord, plus, you're walking down the street on your own. I think the gap is quite narrow.
Student accommodation at the moment, if you look at prime central London as your prime, your yield is probably around 4.25% to 4.5%. Moving out across the spectrum to, say, a tertiary university city, where it might be sort of around circa 7%. I'd place somewhere like Bristol as a prime student town. That's probably somewhere in the low fives at the moment. Trying to give you a sort of feel on where the net initial yields would sit.
Sorry, is that gross or net?
That's net. So that's effectively, gross income minus all your operational costs. Yeah, no, otherwise it'd be a bit hot. I think actually just touch on yields and just one more thing to say about the student market and why the institutions and why the market is still very positive about it. If you look at the peak to trough in yields in the last downturn, so student probably peaked in 2007, and at the time, blended yield across the country was about 5.75% as an average. When the market sort of dipped at its lowest, it was probably 2009 in the student accommodation market. Yields for direct let stock were probably about 6.75% as a blended average. So the peak to trough was about 100 basis points. If you compare that to the All Property Index, the peak was about 2006, yields about 4.6%, 2008 it plunged 6.75%. So the yield shift was probably about 215 basis points. So Student really did demonstrate its sort of resilience on a yield play, again, driven by all the sort of operational, occupational elements that we sort of really just gone through.
Okay, so if I could sort of pick up from there and just do a quick overview on the group financials. Refer you to page or slide 7. I really just have a run through some of the key financial figures for the group and see some of the key performances that we've achieved over the reporting period. You'll be aware, obviously, that Watkin Jones admitted to AIM on the 23rd of March, and we reported very shortly after that our first or maiden results for the 6 months to 31st of March this year. Very positive first set of results that we were able to report, very much as we expected. The headline figures really off the page here. Revenues for the group overall, we increased by 40% relative to the equivalent period for the prior year. And so revenues at 145.9 million for the 6-month period. At the operating profit level, importantly, and before the exceptional costs of the IPO, operating profit actually increased 83.5% to 17 million, compared to 9.3 million in the prior period. I'll talk more about that as we go through the financial presentation, because the sort of margin performance within the group is a key factor for us in that. At the EBITDA level, there's not a lot of difference really between our operating profit performance and EBITDA. We're a very capital light business, so we don't hold a lot in terms of fixed assets, for example. So depreciation charge is very low within the business. So operating profit and EBITDA very closely aligned there. The earnings generated resulted in an EPS for the group, about 5.2 pence per share for the 6-month period, again excluding the exceptional IPO costs that we had. I think importantly, and again a sort of reflection of the model, I'll come on just to look at the cash flow for the group in a moment, but cash performance for the group are typically very strong as well, and really follows very closely the earnings performance for the group also. At 31st of March, we actually had a cash at bank figure of 32.6 million. And as a management team, we do look very closely at the cash position rather than the net cash position. Our net cash position at 31st of March was actually 15.4 million. So between cash at 32.6, we actually had debt in the business of about 17.2 million. Now, the debt that we do have is very much specific project-related loans or loans that relate to land assets that we might hold and so on, very much ring-fenced against those individual assets. And therefore, our real cash number, the 32.6 million, is generally what we would see as the free cash within the business to continue the sort of development programme and site acquisition programme that we've got. I think as well, at the time that we came to market, we were and did conclude a new 5-year revolving credit facility with HSBC. That's a £40 million facility that we have available to us there, as well as a £10 million working capital facility as well. At 31st of March, those facilities were not utilised at all. And really the intention behind those facilities was to give us the additional firepower and flexibility in terms of our future development programme and land acquisition programme.
So that's committed till 2021?
It is, yes. It's a committed 5-year facility. The last point on the slide, we did pay a maiden interim dividend on the 30th of June of 1.33 pence per share. And intentionally, given that we came to market on the 23rd of March, we have effectively 6 months left in this reporting period. So for the full year, or for the 6-month period, effectively we will be paying an overall 4 pence per share dividend. So the initial interim dividend paid was effectively 1/3. We'll pay the next 2/3 in February next year is the intention once we've obviously reported on our final figures.
Excuse me, do you think next year you'll go with your intended 2 and 4 pence to achieve that?
That is correct, yeah. So we when we came to market, our statement was that we would come forward with an initial dividend of 6% on the issue price for the shares, and that's still our intention for the coming year and going forward. And I think perhaps just to touch on that now, whilst we're talking about dividends, we are a very sort of cash generative business, and again you'll see that when we look at the cash numbers. With a 6% dividend, initial 6% dividend yield, we would expect that to be at least 2 times covered on our earnings and cash flow generation. As the intention really is that we will have a very progressive dividend policy going forward, so we would look to increase that underlying dividend very much in line with our sort of increase in earnings as we go forward. But even then, I think when you look at it, where we will be within a reasonable time frame is in a very positive cash position. And one of the questions may indeed be then, what are we going to do with that surplus cash that should build up within the business? We will look at opportunities and options in relation to that, but at some point I think the intention would be that we would pay some enhanced level of dividend or potential special dividend if that's appropriate at the time.
So you're not doing that to tie up working capital?
No, not at all. So if we just go over to the next page, and we show the profit and loss statement for the group. Really here, just a couple of highlights that I want to pull off the page and refer to. You can see very clearly from the pie charts that are shown there, where we show the revenue by division and gross profit by division, the significance of our student accommodation development activity within the group. Revenues for the group for the 6-month period, 84% of revenues came from student accommodation developments, and effectively 94% of our gross profit was generated from student accommodation. You can see a small green sliver within the pie there, which is Fresh Student Living, and Fresh Student Living Limited as a business was acquired into the group on the 25th of February. It was originally set up by the Watkin Jones family essentially, but sat outside the group. We formally acquired it into the group on the 25th of February. Fresh represents a very significant and important part of our overall offering to our clients, and importantly, I think as well for the group, represents a significant growth opportunity in terms of visibility on future revenues and earnings as well. I think the other sort of point to note here on this particular page is the growth in gross margin between the half year to 31st of March 2015 and half year to 31 March 16. Gross margin increasing there effectively from 14.7% to 16.1%. The significance of that, and again perhaps on that if we just turn over the page to the segmental summary that is shown here. The key segment for reporting purposes at the moment being obviously student accommodation. What we see within the student accommodation division is gross margin increasing from 14.8% to 17.9% over that equivalent 6-month period. Historically, the business used to do an element of more contracting-led student accommodation activity. So, for example, we are completing our last student accommodation contract at the moment for one of the universities, which is Heriot-Watt University. That contract completes in this financial year. Historically, however, we did do more in the way of contracting-led opportunities. The gross margin inevitably on contracting work was much less, whereas now our portfolio of developments that we're bringing through is very specifically our own developments that we're bringing through and developing. And given that we have a hurdle rate of 20% when we're appraising developments, what we're seeing is that sort of strengthening margin very much feeding through our numbers. So whilst we've seen this increase to 17.9% in the first half of this year, we will see that increasing further in the second half and going forward into the future years. Added to as well by virtue of the fact that as our geographic sort of spread has increased as well, we've been able to secure good site opportunities in London, particularly in the south. We're seeing strengthening margins coming through on our opportunities there as well, and we have been very successful in securing sites that are enabling us to deliver some extremely high margins into the group. So that margin we will see strengthening as we go forward. Student accommodation, as Mark has touched on, one of the key things for us here is that it does give us absolutely fantastic visibility on our revenue and earnings coming into the business. If you look at our sort of position at the moment, clearly for the year that we're in at the moment, essentially all of our schemes are forward sold and being built through now to completion. All but one, I think, of our schemes for FY17, so the year ahead, are forward sold already. So again, we've got that sort of underpinned position and visibility on our revenue and earnings coming through there. And we're very much working on the following year, FY18, and indeed FY19 as well, to underpin those years also. The residential segment within the business we haven't really talked about at all, but we do also have a more traditional house building operation within the group as well. Historically, it's been much more largely focused on the northwest, North Wales geographic markets. We do have a fairly significant land bank still of residential sites that we can bring through and develop, as well as looking at very sort of selective new opportunities there where we can see similar margin returns to that which we achieve in student accommodation. For the 6-month period through to March 16, we actually achieved 79 sales completions compared to 26 in the equivalent half year last year. And I think perhaps encouragingly, pleasingly from our point of view there, about £10 million increase in revenue, which largely came through from selling a number of apartments that we'd built in Chester, and also a number of apartments and houses that were built in East Manchester as well, from assets that were really what we would see as legacy assets within the group. So they were assets that we really had held and developed more historically, delivering relatively low margins on those, but really importantly, bring a lot of cash into the group as well as we achieve those sales. And I mention that point because I think there's also significant further opportunity within our balance sheet to release cash from historic sites and assets that we hold in our balance sheet. For Fresh Student Living, here for the 6 months through to 31st of March 16, we've shown the comparison on a standalone basis for Fresh Student Living compared to, again, the performance for the prior period. What you can see there is that revenues for Fresh increased effectively by 86% to £2.2 million compared to the equivalent period last year, which just gives an immediate indication of the rapid scaling of activity within that business. The FY 2016 revenue and margin performances from 8,310 contracted beds under management that we have for the current financial year. But it is already the case, based on the contracted schemes that we have going forward, that by FY 2020 we'll have 17,900 beds under management, and that's effectively our contracted position at the moment across 59 schemes there. So significant scaling up on the Fresh opportunity. That's what's contracted at the moment. Clearly, we're working on other opportunities there. What it doesn't include are developments that Watkin Jones will be bringing forward that aren't yet sold to our clients, where if they engage Fresh as the management team, that will add to those numbers there. So we'll see significant growth on that. So in terms of valuation, when we acquired Fresh, we paid £15 million to acquire Fresh into the business. It was based on certainly a higher multiple than we would have applied to the Watkin Jones development business, and we were looking at a multiple of around about 15 times on its earnings, given that what Fresh really offers are contracts which are typically sort of 5 to 7 years in duration, So you've got good visibility again there on the earnings that Fresh can bring in. And really, given again that you have a sort of very sort of clear contracted position on that earnings profile, the sort of the valuation metrics on that do warrant a much higher multiple applied to the Fresh earnings stream than the more traditional Watkin Jones development model.
So was Fresh Living brought into the group then to tidy it up for any conflicts of interest prior to the IPO?
It was certainly partly that, absolutely. I think it was also to recognise that from an institutional point of view, our clients, generally speaking, do look to Fresh as a key part of the overall offering that Watkin Jones is providing. It really seemed absolutely appropriate that in terms of a market, to bring Watkin Jones to market, it needed to have the full sort of cradle to grave offering as part of the solution that we provide. So
I think the driver behind it as well was I didn't want to. Could have left it in, left more free cash. The family could have taken more free cash out, but I wanted to bring it into the group pre-IPO rather than coming back to shareholders post-IPO and saying, can we raise £15 million or whatever it might be to acquire Fresh now? So it's about sort of tidying up, as you say, to give that end-to-end solution day one, and not having to come back to shareholders asking for additional funds to acquire something which, you know, morally we should have acquired pre-IPO, which is what we did.
And I think just to, as well, before I go off that page, just to pick up on the points at the bottom of the residential segment review there, it will be the residential segment within the business that really picks up and will take forward the opportunity within the PRS sector as well. It's ideally placed to do that by virtue of the expertise and experience it's got in the residential sector. It's done a significant number of apartment developments historically, as well as then aligned with our experience in student accommodation. We're ideally well placed on the PRS opportunity. On the balance sheet then next, on the next page, again here really to sort of pick up on the couple of key points here and the opportunity that I think was within our balance sheet. A couple of things I really just want to highlight here. First of all, intangible assets, which is shown at the obviously the 31st of March 16 numbers that wasn't there sort of previously, really relates to the acquisition of Fresh Student Living. So it was principally the valuations that have been formally done for the intangible assets associated with Fresh. So goodwill, effectively, sort of value of the customer agreements and so on that it has in place within that company. I think more importantly, looking at the current assets and inventory and work in process, and to pick up on the split of land and so on that we've got here. At 31st of March 16, the group is still holding £90 million worth of inventory and work in process, all stated at cost. So historic cost, cash spent historically within the business. Within that, of that £90 million, £39 million of that is land assets effectively. And if you split that further, about £17 million of that is our residential land bank. So there's about £17 million of land sites that we hold really across the northwest, and also one or two in the Midlands as well, for future residential development. Also then within the £90 million, we've got about £50 million of work in process and stock. And importantly within there, there is about £26 million, which is built stock of, again, largely residential assets, 3 built residential apartments that we hold in, again, East Manchester, and 2 particular assets in Sheffield. We will be looking going forward to achieving sales of those assets and effectively then also converting those assets into cash as well within the group. Those residential apartments represent a good opportunity there to be part of a seed portfolio of PRS assets that we will look to trade. and therefore we're sort of optimistic in terms of being able to take forward and achieve sales of those assets going forward.
So I think on timing for that.
Timing. It will very much depend upon where we get to with negotiations that we're having on with various potential clients at the moment there. But I would certainly like to see that we are either achieving a full sale of those assets or proportions of them over a 3 to 5 year horizon.
Just looking at that, actually, could you guys talk, I mean, you've got obviously a really good business model, really strong balance sheet. What was the thinking behind the IPO? You obviously didn't need to raise cash. Being private.
Yeah, I think there's a couple of things. There's take the wider family out, because there's only me working in the business, and I felt that it's an opportunity for the wider family to realise some value, but allows me to take the business to another level. It aligns us, or has aligned us better with our clients and opened us up to new clients. I think also as well, we've got a very strong management team, but working for I recognise that when they work for a family business, I felt that there was some holding back in that management team, in that they maybe were trying to second guess what the family aspirations or drivers were. Whereas, what I've been delighted about since we've done the IPO, and which what I was hoping, was that we've now got a much more tangible ownership of the business, as opposed to having share options. And I think we're driving the business much better. There's a lot more challenge coming back to me, which is good and refreshing, and that's what we wanted to try. And I think we can really take the business forward, and that was my aspiration, and that's what I can see happening. So that was the reason.
In terms of cash flow, I think the main point I really want to sort of bring out here is really what we've talked about in terms of the cash generation within the business. The forward sale model that we have is an excellent model in terms of its ability to convert effectively revenues and earnings through to cash. So we are very capital light. We have very little requirement for working capital within the business generally. And each year it is typically the case that broadly 100% of earnings translate through into cash each year. So apart from, as we outlined, some cash requirements at the start of a development in terms of planning costs and so on, as soon as we achieve the land sale and then into the development phase, we're effectively cash positive at every step of the development cycle. But typically, our development profile works such that most of the development agreements that we enter into allow for a bullet payment to be made on completion of the development, effectively as an incentive to making sure that we obviously complete the development on time. That can be typically 10% of the build value altogether. Given the fact that most of the developments then are completing in the final quarter of the financial year, it typically means that we have a significant cash inflow in the final quarter of each year. And so year on year, we will see what I would describe as a hockey stick effect, really, on our cash flow. So we'll be cash positive in the year, but a significant upturn at each financial year end. If we look at the 12 months through to 31st of March 2016 compared to the 31st of March 2015 position, we actually achieved an increase in net cash of £19.4 million over that 12-month period. But that masks the fact that when you take into account the costs around the IPO itself, which in total, in terms of exceptional cash utilisation, we spent about £51.6 million in the 12-month period. Our real underlying cash generation for that 12 months was about £71 million. So a combination of the earnings that were generated and again realising cash that was tied up in the balance sheet. And I think it's worth mentioning here that I mentioned there £51.6 million of essentially exceptional IPO costs. We spent £15 million acquiring Fresh into the group, which we talked about before. There was a pre-IPO dividend that was paid to the existing shareholders of £10 million. And then we reported £26.6 million of IPO-related costs. 6.5 million of those were the fees and commissions associated with the IPO, but more importantly, £20.1 million was the cost effectively of settling the existing incentive programs that were in place with senior management within the business. That senior management team has reinvested 70% of that money into Watkin Jones PLC in terms of shares acquired. What that means as a senior management team is that we're absolutely aligned with our shareholders generally in terms of pushing forward the success of this business, and important as well, because we already have that investment in the business, there is no requirement at all for any dilutive longer term incentive plans or option arrangements for the senior management team. It's effectively that's already catered for in the shareholdings that we've got. So I think in terms of the key message there is very strongly cash generative, good visibility on that, and we will see that cash number progressively increasing year on year as we go forward.
Given that you have quite clear visibility as to your future earnings, your developments in hand, these are the historic numbers. What is the expected outturn for FY16, 17 and 18?
I'd like to be able to answer the question, but I think we can't probably. I think we're probably not at liberty to really say that.
Are there forecasts out there?
There are forecasts available within the research notes that are available from Peel Hunt and also from Zeus Capital, and I'd ask you to refer to those.
So one of those research notes as being more accurate than the other, because as we know, brokers' notes can, depending on whether it's a house broker or an external broker, can come up with quite a variance of views from talking to the same management.
I think I would say that the approach of both Zeus and Peel Hunt in terms of how they arrived at their forecast numbers that they've reported, both taking quite different approaches to doing that in some ways. But I think interestingly they have a fairly consistent view on what our sort of earnings and cash flows will be over the sort of 3-year forecast period. So clearly they've arrived at those numbers through discussion with ourselves, and I wouldn't draw on one more than the other. I think it's a sensible blended position if you were to look at both of those.
I think we've all enjoyed tonight, clearly by a number of questions as ever. We get through a lot. But thank you to all three of you for explaining what the company does and where it's going. I think you've done a very good job of giving us all the knowledge we need.